All right, so let's talk a little bit about the yield curve and what it's been doing and how to read the signs to profit in this kind of environment. Now, since last summer, the 2-10 yield curve spread, short-term, long-term yields, right, has been steepening consistently. That's a trend that picked up some steam after the presidential election. Our next guest has thoughts on that and also says that despite all the sell-off in AI stocks, investors can still use that space to their advantage. So joining me now is Jan Szilagyi, the CEO and co-founder of Reflexivity, a firm that uses AI and machine learning to glean things about the market. So Jan, take us through what you're seeing and what your models are seeing and what it can mean for investors.
Yeah, hi, great to be on the show. As you already mentioned, Reflexivity's purpose and mission is really to monitor all sorts of developments in the vast space of kind of market data points. And currently, one of the more interesting ones is the fact that, as you already mentioned, the yield curve has been steepening. In other words, I think investors are very clearly anticipating a period of higher economic growth and also, as a result, higher inflationary environment. What the system is highlighting is that during that period, the sectors that have tended to do by far the best are generally cyclical sectors. So things that you see outperform are real estate, materials sectors, also consumer discretionary and industrials. And the margin is not small. They outperform the kind of less exciting sectors and less cyclical sectors like utilities, healthcare, and so on by 3-to-1. So it really is quite a big difference. Again, presumably not a huge surprise to veteran investors, but that is the kind of the upshot on the sector side.
So if it's going to be cyclically oriented, economically growth oriented, what parts of the market do you think will, or what does the data suggest will outperform in that kind of environment? You laid out some sectors, but if you were to place bets, where do you think the biggest octane boost comes from?
Yeah, I mean, I think presumably you are going to see actually quite a lot of gains specifically on the kind of industrial and consumer discretionary side. I think industrials are interesting to watch because we can see that there is a push on the side of the current administration already to really boost manufacturing in particular in the US. So I think you are going to find some interesting names there without going into individual stocks. I think that's the space absolutely to watch because generally it's the less exciting one for a lot of investors. The ones, again, to avoid are then names in the utility sector with the caveat, and to the extent that we get to talk about it in a little bit, of those that have exposure to AI. So obviously in the utility sector, generally as rates rise, those stocks underperform, but there will be exceptions like Constellation Energy and so on.
Yeah, I know you think you're sort of still in the camp. We're going to see a lot of adoption of this and be careful betting against it. Jan, we appreciate it.
Thank you very much for that.